I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in the markets. Today, we're going to get started with the unbelievable surge that we've seen in European natural gas prices. I think you'd have to be hiding under a rock if you're unaware of the situation. There was a headline on the terminal about an hour ago proclaiming that European natural gas prices had surged 60% in the last 2 days. Meanwhile, we saw National Grid CEO saying that the UK has plenty of gas supply for the winter. Clearly, there's a challenge in commenting on a commodity that's moving so quickly. But with that in mind, we want to start with Patricio Alvarez, who looks after our utilities coverage and our European gas coverage. So, Patricio, I realize you're in a bit of a conundrum here, but how do you characterize what we're seeing in the market right now, and how do you look at the next few months?
So, in terms of what's going on in the market, we've been describing this as just an increasingly tight market due to the low storage inventories in Europe. They are abnormally low. They're below the 10-year norm. So just for context, we are tracking at around 76% capacity at the moment, and this compares to the long-term average of about 92%. So that means that we're still very, very tight, which means that we see more price volatility. It's hard to tell, as you well point out. It's hard to tell whether it's to the upside or the downside. But in terms of catalysts and things that we see moving forward, we sort of do have we agree with the view of NatGrid's CEO by saying that there is enough gas, at least in the UK, to sort of avoid any energy supply, energy security issues, though it could remain increasingly tight. According to his own statement, we have nearly, just about 100 MCFs of sort of a leeway if the winter is very cold. So that means that, for example, just in the context of last year, we consumed about 65% of the storage capacity in Europe. This year, since we're at 75% more or less now, entering November, when the withdrawal season really kicks off, we can see that there's only a 15% leeway, and that's also considering that 2020 was an abnormally warm winter, at least in the beginning. So it will all hinge on the weather in terms of demand, and on the other end of the supply and how we can see things sort of normalize. It's first of all LNG. LNG netbacks to Europe are outbidding JKM, which is the Asian benchmark, which means two things. It means that demand for LNG cargoes in Asia is somewhat cooling off, at least sequentially from last month. And also, it means that Europeans are outbidding them in this sort of effort to replenish supply storages right before there was the heavy withdrawal season. The other key catalyst is it's Nord Stream 2. And although there's still somewhat uncertainty as to when the pipeline may start, we see this happening probably by early next year, due to the fact that they have to go through EU regulatory approvals. And just a note on that is that we saw the price for TTF, the Dutch TTF gas price, pull back a little bit today, just on some positive news on Gazprom's sort of legal bidding, in which an EU judge basically gave a favorable outcome on sort of one of the regulatory hurdles that they have to come across to be able to on-stream. Though it's still very early to say what the implications will be from that. It definitely shows you how volatile the market is just to the headline sentiment. And we see some potentially downside price risk on these sort of headline events, such as the approval of Nord Stream, improved LNG cargoes in the near term, and also increased flows from Norway.
Patricio, you mentioned regulation. Is there much that policymakers can do in the near term to get us over this winter? I mean, this run up has to have incredible implications for um, ordinary citizens, consumers, businesses. Are you worried about some kind of regulatory blowback from this? And I would note just on Monday, the United Kingdom said that by 2035, they want the power grid here in the UK to be carbon free. Are they thinking about the wrong thing? Are they focused on the wrong topic when they're thinking about 2035 and not this winter? And what kind of pushback are you seeing out of whether it's Brussels or here in the UK as for what regulators may be thinking about to do both over the winter but over the next few years in terms of thinking about gas dependence and reliability?
Sure, there's a lot to unpack there. I think in the short term, just trying to get through the winter, we expect power prices, and natural gas prices to remain quite elevated versus the historical norm. And we've already seen sort of signs from EU governments intervention into the market and just trying to protect household customers, and that has seen sort of a mixed ways of going about this. For example, proposals in France have seen proposals to reduce taxes and power levies on power prices to sort of protect customers. The other end of the spectrum, which seems a little bit less favorable for utilities, for the utility landscape, is in Spain, where the government has announced a windfall tax, sort of trying to strip out the benefit of higher natural gas prices from the utilities margins and sort of claw that back through March 2022, which is the point where most people, most incumbents see gas prices cooling off. So that's, I think, the response we will see in the short term. Just governments try to act either via fiscal measures. We don't see a lot of interventionist sort of measures aside from Spain. But these are sort of the measures in the near term. There's not much else you can do. In terms of structural reforms moving forward, again, what we've heard the most out of the EU Commission on this topic is that they will probably accelerate renewable targets and renewable deployment. This will not deter their efforts, the region's efforts to become a green economy, and this plays well with the UK's 2035 goal to become 100% fossil fuel free by 2035. But the other part of that trend is that we also see Europe taking steps to tweak the transition plans, the strategy. We've seen more development on trying to implement strategic gas storage reserves, something that we see similar to what the U.S. has with the Petroleum Strategic Reserve, just sort of to ensure a minimum baseline sort of supply security. And we could also, we look with expectation to what may happen with coal phase out dates, nuclear phase out dates. We definitely see adjustments to that in the long term trajectory of the energy transition.
Very interesting, Patricio. Stay on. We'll probably come back to you, but let's bring on Will Hares, our senior oil and gas analyst. Will, you cover the integrated. TotalEnergies just laid out their strategy outlook a week or two ago. I believe they had some very interesting things to say about the direction of energy markets generally. How is a company like Total, which thinks about increasingly investments on the gas and power side of the business, uh, what does it make of the run up we're seeing in gas prices here in the short run, and is it affecting any of the strategic thinking that they have about the next few years?
Yeah, so thanks, Rob. I would say that Total is probably one of the more interesting oil majors to take a look at when we're looking at some of the energy transition themes. And this is mainly because we think it's the best positioned major for the energy transition. It's been one of the earliest movers on building out their renewable portfolio. They've been very aggressive in expanding their LNG portfolio as well, but also retaining a meaningful oil exposure as well. So on the natural gas sort of mania that we're seeing in Europe, I would say this didn't really feature very heavily in the company strategy day last week, mainly because a company of this size strategy unfolds over many years, if not even a decade. But there's some interesting comments by the CEO, Patrick Pouyanné, said that they expect elevated pricing levels in natural gas and power in Europe moving forward through this winter, and also supported the view that this is from an underinvestment in the upstream side. So but with that, I think it's also quite important to sort of frame it against their strategy, which is one that is moving ahead regardless of these prevailing movements in natural gas and power markets, and that is that the energy transition is accelerating very quickly. They have the largest renewable power target of any oil major, which is 100 gigawatts of installed capacity by 2030. The company is also, as I mentioned before, expanding their LNG portfolio meaningfully. And I think one of the more interesting tidbits from the release last week was that the company expects only 30% of its sales mix by the end of the decade to be from oil. So this just really shows that it, as an energy major now, it's really transitioning quite quickly to becoming a majority gas and power producer from oil. And I think they are leading this way among global oil majors, and I think many more are following in their path to varying degrees.
Okay, well, I think there's many directions I want to take after hearing your comments, but there's two ideas that I really want to hit on, and one of them is going to involve Salih, and one of them perhaps not. One of the ideas is, okay, what's the role that nuclear is going to play? And I kind of want to get broad scope on that. But before we go into that, because that's a bigger, longer term question, there's a lot of discussion about the idea that gas prices are so high that power generators around the world are going to be burning more oil in power plants this winter. And so for that, I want to bring on Salih Yilmaz. Salih covers the oil and gas industry for us as well, with a particular focus on some of the Middle Eastern national oil companies and OPEC coverage. So Salih, give us a sense, how much power are we going to see, or how much oil are we going to see diverted into power use this winter? And what's the implication for the oil price?
Sure, thanks, Rob. I think this is a very interesting point, and the knock-on impact of the surge in gas prices into oil is something that we kind of thought about a couple of weeks ago, and we are kind of seeing that unfold now. And this kind of what they call the gas to oil switching, as some of the power generators and some oil refineries as well, mainly in Asia, which still have this kind of capacity to switch between one and the other. We are seeing a lot of estimates come out ranging from about 370,000 barrels per day to about 1 million barrels per day of impact that the surging gas prices will have, because these consumers will seek alternative fuels and will go to liquids. And actually, it was interesting. Earlier in the week, the Aramco CEO, Nasser, said that number may be about 500,000 barrels per day. Again, quite a range, but it seems like it is going to be a meaningful number. And this is interesting because that's what the Aramco CEO said, but also on the same day, there was an OPEC meeting, and the OPEC meeting decision was to ratify the initially planned 400,000 barrels per day of initial output for November. So again, this probably was designed to kind of meet the already expected demand increase for that month before we saw this kind of huge surge in gas prices, which is expected to bring this additional demand. So when we look at the oil market, I think we are looking at obviously not as tight as the gas market as Patricio mentioned, but we are looking at a tightening market for the rest of the year. I mean, it's a different story when we look at next year, when we kind of we here at BI see a little bit of a slowdown in the revival in demand, and also we do see a lot of kind of non-OPEC growth coming back, and we do see the market flipping into a surplus again next year. But when we look at the very near term, and this, as you mentioned, this kind of gas to oil switching happening through winter, I think we are looking at some additional barrels on the demand side and continued constrained supply by OPEC, which I think is going to be can be supportive for oil prices as well.
Thank you, Salih. We're going to come back and circle around some of our research on the oil market here on the call, but I want to come back onto this idea of fuel switching in the power market, right? So, Salih, you just talked a little bit about what potential we could see from oil-fired generation globally. I certainly get the sense that here in the UK, we're going to see stronger coal generation this winter, in spite of the idea that by 2025, the UK plans to phase out all of its coal-fired power plants. So I want to get a sense from both Patricio and Will, what do you see unfolding in the near term to kind of get the power market back into balance? Is there going to be less reliance on gas? Are we going to push harder to wind, solar? What is the role of nuclear? Does it take too long to build nuclear power plants? So, Patricio, what's your sense? How quickly can the European Union, you already mentioned there's a desire there to continue with the energy transition. How quickly can they do it? Will it have a meaningful impact on gas demand by, say, next winter?
So just touching upon the last point, which is nuclear, that will not come anytime soon. The soonest commissioning of a new nuclear plant, at least in the UK, is set for 2026, and according to their long-term plan at the moment, they don't expect to initiate on any new plants until after 2035. So with the earliest FID or final investment decision set for 2024. So nuclear will not provide any near-time solution. But on the flip side, if we talk about renewables, wind and solar, the lead times for those types of projects are much shorter. Like a solar farm could be built in less than a year, and a wind farm, depending on the scale, can take up to a few years, depending on the size. But we see those as sort of shorter term solutions. Another source could be green hydrogen, which has been sort of seen as this fix to the intermittency equation, as it could store renewable power in the form of hydrogen. So, but again, we see that as very long-term sort of solution. We have very nominal capacity at the moment, and most of the projects across Europe are still on the pilot stage.
Will, I want to bring you on. Break down that mix. I mean, one way the market could go is more nuclear, but as Patricio noted, it takes quite a bit of time. But hydrogen's another potential. TotalEnergies laid out their strategic vision. How do they see it unfolding? Is hydrogen going to be a real thing?
Yeah, I mean, hydrogen is definitely going to play a role moving forward, and all European energy majors have some exposure in their portfolios to it. But I think it's, as Patricio just mentioned, it's pretty marginal at current stages. And although there's some pretty ambitious projections for where the hydrogen market is going, it is not going to be a significant energy source in the global mix within the next decade at least. So where does that leave us? As Pat mentioned, nuclear have very long lead times. We've seen a lot of cost overruns and delays, so that also is not a real feasible solution near term from a climate standpoint, in my view, or clearly from the pressures we're seeing right now. And so I really think that it's going to end up in one area, which is at least in the UK and Europe, we're going to see, or we are seeing, just an extension of rapid deployment of offshore wind and solar. So in the UK, we are expecting a more than doubling of their wind capacity to over 60 gigawatts by the end of the decade. But of course, this does not also mean that gas is going to just disappear. There are intermittency issues with renewables, as evidenced just a few weeks ago in the UK, where we had roughly nearly 2 weeks of very low wind speeds, and we saw renewable power generation really fall off a cliff. So gas will continue to play a role within power gen, albeit probably declining over the next 10 years, because we just need that base level of power generation to and to help offset in the peak times, and particularly when intermittency issues arise for renewables.
Okay, very interesting. Salih, while we're on the concept of transition, I just want to get one more thought from you, particularly on the oil market side of the equation. I believe I saw a headline the other day that indicated that more EVs were sold in the UK in September than had been sold in the prior calendar year. So EVs are really booming sales-wise. UK, Europe broadly. What do the particularly the OPEC member nations make of the rise of EV sales? Are they shrugging it off at this point? And how do you see their thinking evolving on this topic?
So it's not really being mentioned that much in these meetings, and EV adoption and how fast and how rapidly it's been coming for oil demand is something that we've been discussing for a while now, and it is coming for the biggest portion of oil demand, which is road transport. The thing is, when we still look at the estimates from OPEC, from many of the agencies, they still kind of, especially OPEC's own estimates, still see demand kind of going resilient and going up in the next decade or so. But the thing is, when we do see EV adoption accelerating, not just staying at the impressive rates that it is on at the moment, we do see it as a very big challenge for oil demand, for oil prices, and all these kind of oil companies and NOCs especially that haven't really been, I think, thinking about energy transition as much as some of the international majors such as Total that Will has been talking about. So I think it's a reckoning that's coming. It's something that we've been talking about for a while now, but I think we will continue to see kind of acceleration in the adoption, not only in countries like Norway and the UK, but the rest of the world as well. And I think it will start kind of chomping away from the growth of oil demand, along with other things such as fuel efficiencies in the internal combustion engine cars as well.
Okay, Salih, thank you very much. Okay, with the few more minutes that we have left here, I want to switch gears, move out away from this very interesting dynamic we're seeing across the energy complex, and move to a specialized bit of research that Will Hares put out in the last week. So, Will, you've had a focus idea, and again, for anyone who doesn't know, focus ideas are highest conviction, most differentiated calls about some of the companies that we cover. And you actually closed successfully one of your focus ideas on Petrofac. So tell us about the idea. tell us what you had projected as part of your outlook, and tell us what actually happened.
Yeah, thanks. So Petrofac is an oil and gas servicer that most focused in the Middle East that has been embroiled in a multi-year serious fraud office investigation relating to alleged briberies made by some of the officers of the company in order to receive major awards for work to be done. And this investigation was announced in May of 2017, so it's been ongoing for several years, and the company has suffered significantly as a result of it. It's lost its valuation has dropped a lot. Its award intake has suffered. Its reputation has suffered. And so our focus idea was that the penalties that the company would face as a result of this investigation would likely be lower than expected by consensus. And we just found out last week that the Serious Fraud Office had agreed with Petrofac, and Petrofac pleaded guilty to 7 counts of failing to prevent bribery on the award of 3.6 billion of contracts awarded to the company, and it really fit quite well with our view. We had estimated potential financial penalties of 235 million to 400 million, and these penalties came in just below the low end of that at about 180 million. This is pounds. And so this met our expectations, but it also came in significantly below where the market was expecting, and the share price has increased roughly 70% since this. And then also on top of that, the Crown Court, which has the final sole discretion in the penalties, actually reduced the penalties even further from the guidance from the Serious Fraud Office, which is as a result of the company's transformed leadership, culture, and compliance controls, and also we think sort of acknowledging that the company has paid steep costs as a result of this investigation already, and this is a risk we had highlighted, including that the guidance from the SFO is to not levy penalties that could risk the company as a going concern, or could risk jobs of the innocent employees of the company as well. So overall, the outcome was very consistent with our view, and also I think probably most importantly moving forward now is that this will represent a positive catalyst for the company, because it resolves this multi-year legal battle that has been hanging over the company's investment case for years, and we think will allow the company to resume normalizing bidding activity and award intake, and particularly I think we'll be looking for an announcement from Saudi Arabia and the UAE, which had previously suspended the company from bidding on contracts, which obviously represent the 2 core markets for the company.
Thank you very much, Will. Very fascinating focus idea. I hope everyone had a chance to read it on the terminal as well. I want to thank everyone for joining us today. Again, if you don't know Bloomberg Intelligence, you can find research on everything we talked about on BI Go. We've got 350 research professionals covering all sorts of things well beyond the type of energy coverage that you just heard here today. And we're open. We're happy to answer your questions. So shoot us an IB, reach out over email, and we're happy to speak with you. And we'll see you again on the 3rd Wednesday of this month. Have a great rest of your week. Thanks for your time today.